everybody, welcome back to Dollar Cost Awesome. I'm Steven, and today we're going to be talking about how to build your portfolio to match your risk profile. So if you're newer to investing, figuring out what kind of investments to put in your portfolio might seem a little daunting. A lot of what goes into deciding how to build your portfolio depends on your investment objective and how close you are to needing the money. So for a lot of us, your main investment objective is going to be saving up for retirement. And so that timeline depends a lot on how close you are to retirement. The closer you are to retirement, the lower your risk tolerance is going to be. You want to make sure that you have the money there when you need it when you retire so that you don't have to keep on working. If you're a little bit younger, you have a longer investment horizon, so there's more opportunity for you to make up losses if the market goes down a little bit or tanks like it did in 2008. So really, your two investment objectives, depending on how close you are to retirement, are going to be growth versus income. When you're younger, you have more of a growth investment objective where you want to grow your money faster. And when you're closer to retirement, your goal is more ensuring that you have steady income. So there's a number of different types of investments that you can put into your portfolio. And this works with an RSP or a TFSA. If you're doing a self-directed account, there's really a lot of options to you on the types of investments that you can put into it. So on the equity side, we have things like stocks. That's kind of the most typical thing you'll think of with equities, or ETFs, which are kind of funds made up of a bunch of stocks, or even other ETFs. So with bonds, a bond is basically a contract with a government or a corporation where you provide them some amount of money and they guarantee to pay you some amount of interest until the bond matures. With government bonds, those are pretty safe. There are other types of corporate bonds, potentially with companies that are maybe a little riskier because if they go bankrupt, you lose your investment in that bond. But with a government bond, typically governments aren't going to go bankrupt, so those are typically more reliable. But of course, with less risk, you typically earn less interest on the investment. GICs are guaranteed investment certificates. Those are also very low interest, but essentially you typically buy them from a bank and they say, if you give us $1,000, we'll give you 1% interest after 4 years. So again, pretty low return on your investment, but pretty reliable and safe. Money market funds are typically shorter term loans, essentially a fund that is a loan to a company over a shorter term, where again, it's sort of like a bond where they'll pay you some amount of money and some amount of interest in return for the money that you've put in. And then lastly, there's commodity investments. So this could be things like buying raw gold or buying cryptocurrency. Cryptocurrency is considered a commodity in Canada for tax reasons. It's not considered like buying stocks. It's actually more like buying gold, and yeah, taxed accordingly. And then commodity futures, which is things like it's kind of a bet on the expected price of a commodity. So that could be anything from wheat to oil to potash, even gold. You could also buy futures on minerals like gold. Equity and commodity investments are going to be the riskier ones, whereas your fixed income investments are going to be lower risk. So as your investment objective changes, when you're younger, from growth to be more of a source of income, the closer or once you hit retirement, you're going to want to adjust your portfolio as your risk tolerance changes. So in this example here, you can see if you're, say, 25 years old and 40 years out from retirement, you can be a lot more aggressive with the construction of your portfolio. So you could go 100% equity or stocks, or even mix in some commodities in there. As you get closer to retirement, or to whatever that date is for your investment objective, you're going to start shifting your portfolio to de-risk it. So the closer you get, the more stable you want the investments in your portfolio to be. So you can see here, 30 years from retirement mark, you maybe start shifting a little bit out of equities, more into some mutual funds that are less equity based, or even into some fixed income things like bonds. And then again, once you're 20 years out, you lower it again, maybe go down to 65%. And these are just examples. You should always speak to an advisor and make sure that you fully understand your own risk tolerance, and make sure that you're building your portfolio to match it. And again, as you go down to 10 years, 5 years, 3 years, a year out from retirement, You should always be gradually decreasing the riskier investments in your portfolio, which are typically going to be those equities or commodities, and shifting it more to fixed income investments, so that by the time you retire, it's almost entirely fixed income. You worked hard all those years and you were dutiful about putting that money away into your investments over those years. So you want to make sure that when you go to retire, the money's there when you need it. Hope that video helps you understand a little bit better about matching your portfolio to your risk profile. If you have any questions, leave them in the comments, like and subscribe. I'm Steven with Dollar Cost Awesome. Thanks for tuning in. We'll see you next time.